If you asked your financial advisor what the safe part of your portfolio is, there's a good chance they said bonds. But here's what most people never get told. In 2022, bonds, the asset class built on the promise of safety, had one of the worst years in modern history. Bond funds lost double digits. Retirees who thought they were protected watched their safe money shrink. Meanwhile, people holding fixed index annuities didn't lose a dime of principal that year. Not because of luck, because of how these two tools are actually built. In the next few minutes, I'm going to walk you through exactly how bonds and fixed index annuities really work, where each one shines and where each one falls short, and how to think about which one deserves a place in your retirement plan. This video is for you if you're within about 5 to 10 years of retirement or already retired and you've got a chunk of your portfolio sitting in bonds or bond funds because someone told you that's what safe money is supposed to look like. Here's the problem. That advice was built for a different era, a time when interest rates moved slowly and predictably. The rules have changed, but a lot of the advice hasn't caught up. So today, we're going to compare bonds and fixed index annuities across 5 things that actually matter to you: principal protection, growth potential, liquidity, income potential, and how each one responds to interest rate changes. By the end, you'll have a clear framework, not just an opinion. Let's start with bonds, because most people think they understand them, but they don't. A bond is essentially a loan. You lend money to a government or a company, and in exchange, they pay you interest for a set period, then return your principal at maturity. Here's the part that catches people off guard. Bond prices move in the opposite direction of interest rates. When rates go up, the value of existing bonds goes down. Why? Because new bonds are being issued at higher rates, so your older, lower rate bond becomes less attractive and less valuable if you need to sell it before maturity. This is exactly what happened in 2022. Interest rates rose sharply and bond values fell sharply along with them. People holding individual bonds to maturity generally still got their principal back as promised, but people holding bond funds which don't have a maturity date watch the value of their holdings drop, sometimes significantly. There's also a credit risk to consider. A U.S. Treasury bond carries different risk than a corporate bond, depending on the financial strength of the issuer. Now, I want to be clear about something. Bonds aren't bad. They're a legitimate, widely used tool. But safe is doing a lot of word in that sentence, and it's worth understanding what that word actually means before you bet your retirement on it. Now, let's look at fixed index annuities, or FIAs, because I think you'll see the mechanics are fundamentally different. When you put money into a fixed index annuity, your principal is protected by the insurance carrier. You're not investing directly in the stock market or a bond portfolio. Instead, your growth potential is linked to the performance of a market index, something like the S&P 500, through what's called a crediting method. Here's the trade-off. In exchange for that principal protection, your upside is limited through caps, participation rates, or spreads. I've got a separate video that breaks those down in detail, so I won't go deep here, but the short version is this. You get a share of the market's gains up to a limit and none of the market's losses. That second part is what I call zero is your hero. If the index goes down in a given year, your credited return for that year is zero, not negative. You don't lose principal due to market performance. Many fixed index annuities also offer optional income riders, which can provide guaranteed lifetime income, a feature we'll touch on shortly. That's really a topic for its own video. One important note here: any guarantees associated with a fixed index annuity, including principal protection and income guarantees, are backed by the claims paying ability of the issuing insurance company. This isn't FDIC insurance. It's a contractual guarantee from a carrier, and carrier strength matters. Let's put these side by side across 5 categories that matter most. Principal protection. Bond values fluctuate with interest rates and market conditions if sold before maturity. Fixed index annuity principal is protected from market and interest rate driven loss backed by the carrier. Growth potential. Bonds offer largely fixed, predictable returns based on the interest rate at purchase. Fixed index annuities offer growth tied to index performance, with the possibility of more upside in strong years, but capped, so you won't capture the full gain. Liquidity. Bonds can be sold at any time, at a gain or a loss, depending on the rates. Fixed index annuities come with surrender periods, though most allow penalty-free withdrawals up to a certain percentage each year. That figure varies by product, so it's worth reviewing your specific contract. Income potential. Bonds pay interest income, which can fluctuate as bonds mature and get replaced. Fixed index annuities, through optional income riders, can convert your contract into guaranteed stream of lifetime income. Interest rate sensitivity. This is the big one. Bonds are directly exposed to interest rate risk. Fixed index annuities are insulated from that risk because they're not marked to market the way a bond or bond fund is. Let me make this concrete with an example. We'll call her Linda. Linda is 63, retiring in 2 years. She's got $200,000 sitting in what her previous advisor called her safe money, a bond fund allocation. In 2022, as rates rose sharply, that $200,000 allocation dropped in value, not because of some risky bet, but because of how bond funds respond to rate changes. Now imagine that same $200,000 had been in a fixed index annuity during the same period. Because the annuity's principal isn't exposed to interest rate movement the way a bond fund is, Linda wouldn't have seen that kind of paper loss. Her worst case crediting outcome in a down year would have been 0, not negative. I want to be clear here, this is hypothetical, simplified example for illustration purposes only. It's not a guarantee of how any specific product would have performed, and past performance never guarantees future results, but it illustrates the core structural difference we've been talking about. Now, I'm not here to tell you bonds are bad or that fixed index annuities are the answer for everyone. That wouldn't be honest, and honest is what this channel is about. Bonds still make a lot of sense in certain situations. If you need money in the short term, say within the next 1 to 3 years, the liquidity of individual bonds can be valuable. Bond laddering strategies, where you stagger maturities, can provide predictable cash flow for specific near-term needs. And bonds can still play a role in overall portfolio diversification, especially individual bonds held to maturity. Fixed index annuities aren't meant to replace your entire portfolio either. I think of them as one tool for building a floor of protected and potentially guaranteed income underneath your retirement plan, not a replacement for every other asset you own. So, which one is right for you? Honestly, it depends. It depends on your time horizon, how much liquidity you need, whether you're looking for income or growth, and how the rest of your portfolio is structured. There's no universal answer here, and anyone who gives you one without knowing your specific situation isn't doing you any favors. If you want to know more how to plan for your retirement income, get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. And if this video helped clear things up, hit subscribe. I put out new videos every week breaking down annuities, Social Security, and Medicare so that you can make confident decisions about your retirement. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.